For decades, silver followed predictable cycles until a rare structural signal finally appeared. Markets rarely notice these moments because they unfold quietly without dramatic headlines attached. This time, however, silver triggered a condition last witnessed over 40 years ago. Understanding why this matters requires stepping back from daily noise and speculation cycles. Silver, unlike gold, straddles monetary history and industrial demand, creating unique behavior patterns. That dual role causes long periods of suppression followed by sudden, violent repricing. The last comparable setup occurred during the early 1980s monetary reset period. Back then, inflation, interest rates, and confidence in currencies collided simultaneously globally. Today, silver responded, not gradually, but explosively after decades of constrained pricing pressure regimes. Current conditions echo that environment, though catalysts differ in modern context globally today. A 40-year compression formed as paper markets dominated price discovery mechanisms worldwide. During this time, futures leverage expanded while physical market signals were ignored largely. This imbalance grew unnoticed because stability rewarded participants benefiting from suppression dynamics historically. But long compressions build energy, similar to tectonic pressure beneath fault lines silently. Eventually, structure changes and release becomes unavoidable, regardless of sentiment shifts globally today. Silver now shows technical and structural confirmation of such a release beginning. Phase 1 indicator involves long-term price channels respected across multiple decades, historically prior. Another involves ratio behavior relative to gold currencies and real yields metrics shifting. When these align historically, silver transitions from accumulation to expansion rapidly phases decisively. This shift rarely announces itself clearly until after significant movement occurs unexpectedly globally. That is why recognition matters before narratives adjust and crowd participation increases sharply. 40-year signals are rare because markets restructure through generations slowly over time. Most participants never experience such transitions during their active investing careers globally, ever. This rarity amplifies misinterpretation as familiar frameworks fail unexpectedly under stress conditions today. Many assume reversion because prior decades conditioned expectations of suppression patterns persistently enforced. However, structural breaks invalidate those assumptions by altering underlying constraints fundamentally over time. Supply responsiveness remains limited, while investment demand accelerates during regime shifts globally. Observed industrial demand further tightens availability, creating competition between users and investors worldwide simultaneously. Unlike past cycles, monetary conditions now interact with geopolitical fragmentation, intensifying globally today. Currency debasement concerns revive silver's historical monetary appeal among global investors. Again today, central banks do not accumulate silver, yet private actors increasingly do so quietly. This divergence highlights disconnect between official policy and market behavior. Signals emerging now. 40-year structures often resolve through volatility, not smooth, appreciation phases initially observed. Early stages confuse participants because pullbacks coexist with expanding long-term trends simultaneously. This causes emotional whiplash, separating disciplined observers from reactive traders quickly under pressure. Understanding context reduces likelihood of misinterpreting corrective movements as failure signals. Prematurely forming, silver historically rewards patience during expansion phases, following structural breaks across cycles globally. The 40-year reference matters because it anchors expectations beyond short-term noise. Short-term narratives focus on daily price moves, missing larger transformations unfolding quietly. Media attention typically follows price rather than preceding structural shifts, thereby delaying awareness. Those who study history recognize familiar patterns resurfacing under new conditions again today. 40 years ago, silver surprised markets by defying prevailing consensus assumptions, suddenly worldwide. Consensus then favored paper assets until inflation eroded confidence abruptly across economies globally. Today, consensus again favors financial stability, despite mounting systemic imbalances forming silently. Now, silver's behavior suggests markets may soon reassess those assumptions collectively under pressure globally. This does not guarantee immediate upside, but alters probability distributions meaningfully over time. When probabilities shift, risk management frameworks must adapt accordingly to changing regimes globally. 40-year events demand humility because outcomes rarely follow simple projections. Exactly ever, they signal phase changes rather than isolated trading opportunities within markets broadly. Today, recognizing phase change early provides strategic advantage, but requires discipline and patience continually. This stage invites deeper analysis of drivers shaping the next move in silver. Those drivers extend beyond charts into policy liquidity and physical flows interacting globally. Subsequent discussion examines how these forces interact moving forward from here onward globally. Part 2 explores institutional behavior, historical parallels, and probable scenarios shaping outcomes ahead. For now, understanding significance of this 40-year signal remains essential for investors. It reframes silver not as trade, but as unfolding structural story with consequences. Markets often reveal their intentions subtly before consensus recognizes them clearly. At scale, silver's current behavior belongs within that category of early warnings appearing now globally. Ignoring such warnings historically proves costly during regime transitions across asset classes worldwide. Prepared observers prioritize understanding over prediction during uncertain environments like current conditions today. This perspective frames silver's move as beginning, not conclusion of larger process unfolding. What comes next depends on interaction between forces already set, motion globally today. Monitoring those forces offers clearer insight than reacting to headlines alone during volatility. Silver. After 40 years, signals change, but path remains variable across time frames globally. Understanding that balance prepares investors for volatility without abandoning thesis prematurely under stress. This concludes the foundation required before examining consequences and projections discussed next globally. The next section builds upon this groundwork to assess possible outcomes realistically ahead. 40-year moments deserve patience, context, and disciplined interpretation rather than impulse reactions. Silver now demands that level of attention from serious market participants worldwide today. This awareness sets stage for evaluating implications explored in continuation of analysis. Next long cycles, ending often precede renewed relevance for historically neglected assets like silver. The shift alters portfolio construction considerations across risk spectra globally among investors today. Those adjustments rarely happen instantly, requiring iterative reassessment as conditions evolve further ahead. Silver's message fits within that broader adaptive process, reshaping strategies gradually worldwide. Now ignoring adaptation risks, clinging to outdated assumptions during transition phases already underway globally. 40-year shifts historically separate winners from laggards. Within market cycles worldwide, repeatedly, silver's current signal therefore merits focused, disciplined attention beyond casual observation today, globally. After identifying the 40-year structural signal, the next question concerns underlying drivers. Structural breaks never occur. In isolation, they reflect accumulated pressures finally releasing. In silver, those pressures originate from both physical constraints and financial distortions. Combined, paper markets expanded dramatically over decades, creating synthetic supply far exceeding physical availability. Futures contracts allowed price discovery divorced from immediate delivery obligations. Historically, this separation suppressed volatility while masking true demand conditions underneath surface calm. As long as confidence persisted, synthetic supply functioned as effective price dampener. However, confidence erodes when delivery risks and inventory tightness become visible suddenly. Recent data shows declining. Registered inventories across key exchanges persistently trending downward. While inventories fluctuate seasonally, long-term trends reveal consistent net outflows occurring. Industrial demand intensified as silver usage expanded across technology and energy sectors. Solar panels, electric vehicles, medical applications require increasing quantities annually. These demands compete directly with investment and monetary demand pools globally. Unlike gold, silver supply growth remains constrained by byproduct mining economics. Primary silver mines represent minority of production, limiting responsive capacity. Higher prices do not instantly generate new supply, unlike other commodities. This rigidity magnifies price sensitivity during demand surges historically observed. Meanwhile, geopolitical fragmentation disrupts global supply chains, adding friction costs, energy prices, labor shortages, and environmental regulations slow mine development timelines. These factors combine, reducing elasticity precisely when demand accelerates simultaneously. On the financial side, interest rate cycles shift opportunity costs for holding silver. During tightening phases, silver often underperforms initially as liquidity contracts. But when tightening exposes systemic stress, silver transitions roles from industrial metal. It reasserts monetary characteristics when trust in financial assets deteriorates. Real yields play a crucial role in determining silver's relative attractiveness. When real yields peak and begin declining, precious metals historically outperform. Current environment suggests real yields face downward pressure amid rising fiscal deficits. Monetary authorities struggle, balancing inflation control with financial stability imperatives. That struggle often results in renewed liquidity injections, despite hawkish rhetoric. Markets anticipate these pivots pricing assets ahead of official announcements. Historically, silver responds early because of its sensitivity to liquidity expectations. Another driver involves currency diversification strategies among global participants. As dollar dominance faces gradual erosion, alternative stores of value gain interest. Silver historically functioned as monetary metal during such transitions. Unlike cryptocurrencies, silver carries millennia of trust and tangible utility. Central banks ignore silver, but private capital often fills that void. Retail and institutional investors increasingly seek physical exposure rather than paper proxies. Premiums over spot prices in physical markets signal this preference shift. When premiums rise consistently, they indicate stress within synthetic pricing mechanisms. Arbitrage normally closes gaps, but delivery constraints limit effectiveness currently. This divergence pressures futures markets, forcing repricing to restore equilibrium. Eventually, 40-year structures break when such mismatches reach unsustainable levels. Another element involves regulatory changes impacting market participants' behavior. Higher margin requirements, reduced leverage, amplifying volatility during corrections. As leverage unwinds, price discovery accelerates, revealing suppressed trends quickly. Historical parallels show silver experiences sharp advances following prolonged consolidations. The 1970s exhibited similar patterns, culminating in explosive moves. While circumstances differ, lessons regarding scarcity and confidence remain relevant. Technology adoption now accelerates demand faster than previous decades. Cycles, green energy policies embed silver consumption structurally rather than cyclically. This structural demand persists regardless of economic slowdown considerations. Meanwhile, recycling provides limited relief due to long product life cycles. Scrap supply lags price signals, delaying response during early expansion phases. Thus, physical tightness persists longer than markets initially expect. Another important factor involves investor psychology shaped by past disappointments. Decades of underperformance conditioned skepticism towards silver as investment. This skepticism reduces early participation, allowing accumulation by informed actors. When narrative shifts, late entrants chase price, exacerbating volatility upward. This behavioral dynamic aligns with historical post-consolidation breakouts. Silver's 40-year signal thus reflects convergence of supply, demand, psychology policy. No single catalyst explains movement, rather, systemic alignment drives outcome. This alignment increases probability of sustained trend rather than transient spike. However, volatility remains inherent as markets adjust expectations gradually. Corrections do not invalidate thesis, but test conviction among participants. Understanding drivers allows differentiation between noise and structural confirmation. Short-term pullbacks often coincide with liquidity events unrelated to silver fundamentals. During such events, silver may sell off temporarily alongside risk assets. But recovery speed indicates underlying demand strength post-correction phases. Monitoring volume patterns across physical and futures markets provides insight. Increased delivery notices signal stress within exchange mechanisms. Historically, open interest. Behavior relative to price reveals speculative versus hedging dynamics. A rising price alongside stable open interest suggests genuine demand, not leverage. Conversely, rising open interest during rallies implies speculative excess risk. Current patterns suggest restrained speculation compared to prior peaks. Historically, this restraint indicates early phase rather than terminal phase of move. Another confirmation arises from ratio analysis relative to equities and commodities. Silver relative to equities often leads during regime shifts toward hard assets. Gold-silver ratio narrowing. Historically, precedes silver outperformance cycles. Recent ratio behavior suggests potential inflection consistent with structural thesis, yet patience remains necessary because timing remains uncertain inherently. 40-year signals unfold over multi-year horizons, not weeks. Participants expecting immediate continuation, risk, disappointment, and premature exits. Strategic positioning emphasizes scaling exposure and risk management rather than timing perfection. This framework aligns with long-term structural opportunity rather than short-term trade. Part 3 will examine forward scenarios, potential risks, and strategic considerations ahead. Understanding drivers prepares evaluation of consequences rather than reacting emotionally. Silver's message thus far indicates change, but path remains contested. With drivers established, attention turns toward possible paths forward for silver markets. Structural breaks rarely resolve smoothly. instead unfolding through volatile multi-stage processes. Early stages feature disbelief, followed by shallow participation and persistent skepticism. As price advances, narratives gradually shift from dismissal toward cautious acceptance. Later phases attract momentum, capital, amplifying moves beyond fundamental estimates. Temporarily, understanding these phases helps contextualize volatility rather than misinterpret signals emotionally. In the near term, silver faces resistance from entrenched paper market structures. Large participants accustomed to suppression resist repricing through hedging and liquidity provision. These actions create counter-trend moves, frustrating directional expectations repeatedly. However, sustained physical demand gradually overwhelms synthetic control mechanisms. When physical delivery stress persists, price discovery migrates toward reality. Eventually, one scenario involves steady grinding appreciation punctuated by sharp corrections, intermittently. Another involves sudden repricing, triggered by delivery failure or regulatory shock. Historical precedents show both outcomes possible, depending catalyst timing. Delivery stress often accelerates repricing when inventories approach critical thresholds. Such thresholds remain opaque, complicating precise forecasting efforts. Nevertheless, transparency improves as anomalies become harder. Conceal. Market confidence erodes when settlement integrity questioned openly. Regulators may intervene to preserve stability, potentially altering market mechanics. Interventions could include margin changes, trading halts, or contract modifications. Such actions temporarily suppress volatility but undermine long-term trust. Loss of trust accelerates migration toward physical markets further. Another scenario involves macroeconomic shocks influencing silver indirectly. Recession fears may initially depress industrial demand projections. Yet, monetary responses to recession typically support precious metals. Strongly, silver benefits from both industrial recovery and monetary easing phases. Timing mismatch creates volatility, but long-term direction remains supported. Inflation dynamics also shape silver's trajectory significantly. Persistent inflation maintains monetary demand, while eroding fiat purchasing power deflationary shocks temporarily weigh on silver before policy responses reverse effects. Thus, silver responds not to inflation alone, but policy reaction functions. Currency instability further reinforces silver's appeal as neutral asset. If dollar confidence weakens, silver attracts international demand incrementally. This demand manifests through trade settlement hedging and reserve diversification. Unlike gold, silver's smaller market size magnifies impact of marginal flows, relatively modest. Capital shifts produce outsized price movements historically. This leverage cuts both ways, increasing volatility risk. Risk management therefore remains essential even amid bullish structures. Participants must differentiate allocation strategies from speculative leverage approaches. Physical ownership mitigates counterparty risk, but reduces liquidity, flexibility. Paper exposure offers liquidity, but introduces systemic settlement risk. Balancing these considerations depends individual objectives and constraints. Forward-looking investors consider diversification across forms, jurisdictions, time horizons. Another factor involves technological substitution risk within industrial demand. Innovation could reduce silver intensity in some applications over time. However, adoption cycles remain slow and offset by new uses emerging. Energy transition policies likely sustain baseline industrial demand for decades. This underpins long-term structural support beyond monetary considerations. Geopolitical fragmentation also favors tangible assets immune to sanctions. Silver fits this requirement better than many financial instruments. Supply chain nationalism may restrict exports, increasing regional shortages. Such fragmentation introduces localized premiums. Reflecting scarcity, global arbitrage becomes less efficient under such conditions. These inefficiencies push pricing toward regional realities rather than global averages. Investor education improves as awareness of structural issues spreads. Greater awareness increases participation, reducing dominance of suppression mechanisms. At that stage, silver enters public consciousness beyond niche communities. Media narratives follow price-reinforcing feedback loops. Late-stage participation often signals approaching cyclical peaks. Historically, however, structural cycles may extend longer than anticipated due to scarcity. Distinguishing cyclical peaks from secular shifts remains challenging. 40-year signals suggest secular transition rather than short cycle. Such transitions redefine valuation frameworks used by market participants. Old benchmarks lose relevance, replaced by new equilibrium ranges. This adjustment process includes overshoots, undershoots, and recalibration periods. Patience remains crucial during this normalization process. Overreaction to interim volatility undermines long-term positioning strategies. Prepared participants focus on trend integrity rather than daily fluctuations. Monitoring physical flows, inventories, and policy responses offers guidance. Price alone, insufficient indicator during transitional regimes. Silver's message extends beyond asset performance into monetary discourse. It reflects questioning of debt sustainability and currency credibility. These themes shape broader investment landscape beyond precious metals. Thus, silver functions as signal, not isolated opportunity. Interpreting signal correctly informs broader portfolio decisions. As conditions evolve, participants reassess assumptions embedded in strategies. Flexibility, adaptability, and discipline become defining advantages. The next phase of silver's journey remains uncertain, but significance clear. 40-year events rarely reverse quietly without lasting consequences. History suggests such moments reshape markets, narratives, and priorities. Silver's recent behavior indicates participation in such reshaping process. How far this extends depends collective responses across systems. Watching reactions provides more insight than predictions. This analysis aimed to frame context rather than forecast exact outcomes. Understanding empowers informed decision-making amid uncertainty. If this perspective helped clarify silver's significance, consider sharing thoughts below. Which outcome do you believe unfolds next, gradual grind or abrupt repricing? Do you view silver primarily as industrial asset or monetary hedge? Engage respectfully as diverse viewpoints enhance collective understanding. If this analysis proved valuable, please like the video to support visibility. Subscribe for continued coverage as this structural shift develops further.